Hello everyone, welcome to Property Zone Live again. This is Sean, and today's topic is maybe a term that not many of us have heard before. Topic is from quantitative easing to quantitative tightening, which is the QT. Now, just not too long ago, we have a vivid memory of COVID-19 when it has first lockdown, in order to help to bring all countries' economy back to track and to ease off the burden of a lot of people. So almost all the central bank in the world has taken something called quantitative easing. All right. But now we have come to the tail end of it. And then what we are facing now is the inflation pressure. So you can see the shifting from the central bank focus is bringing the economy back to track by adapting QE. Now is combating inflation using QT. Okay, so without further ado, I actually just want to bring you some of the slides I have created so that I can share with you and we can probably take a look together. All right, so this is a slide. I hope everyone can see my slide clearly. Okay, just a quick review. And I'm sure many of us are already familiar with what's quantitative easing. Basically, in short, there are three things, right? The central bank purchased a large number of securities and government bond. Okay, you're talking about especially Fed purchasing security over time in hope of increasing money supply. Okay, basically, how it works in a layman term is that when U.S. government, I'm talking about, let's say from a U.S. context, when the U.S. government issue the bond, okay, the central bank, which is the Fed, did not buy directly from them. Okay, they will actually buy from the secondary market. Very simple. When Fed need to buy something, they need to use money to exchange. So when they buy the secondary bond from the market, they need to pay with money, their own printing money. Okay, so in this case, when they buy something from secondary market, they will actually push and pump the money to the market through the banking system and so on and so forth. Okay, I think many of us still remember like this is the biggest money printing or money surprise increase uh, that we have never seen before, just less than 2 years ago. Okay, I think last year itself, US has printed about 40% of the money they have ever printed just in a year. Easing credit, normally they refer to reduce the statutory requirement, reserve requirement, or reserve ratio, or SRR, or triple R, depending on the bank. So basically, it allows the bank to lend out more. Of course, the third one is reducing the interest rate. In US, normally we use the Fed fund rate, and in Malaysia, we normally refer to the OPR, overnight policy rate. Now, since we are moving towards the era of QT, the quantitative tightening is just the reverse of the QE. So what we are seeing that now the central bank will actually start selling aggressively if they will be selling. If not, they will not. They will stop buying. They call passive tightening. They will stop buying from the market, reduce the money pumping to the market. Or the worst, they will actually start selling it to the market and actually getting the money out from the market. So in this case, it's called reducing the balance sheet of the Fed, the central bank. Of course, the other one I want to bring up to the today topic, the main things that everyone is focusing on is the interest rate. Because if you are investor, although you are having a loan or you have a fixed deposit, interest rate movement definitely affect all of us. Of course, whether you have money in the bank or you owe money to the bank, an increase in interest rate will give you a different feeling. Okay, you know what I'm saying. Okay, now just not too long ago, about less than a month back, if you look at the date June 15, Fed, which is the central bank of US, has actually hiked its benchmark interest rate by 0.75, which is 75 basis point. This is the biggest increment since 1994 for the past close to 28 years, right? Close to 30 years, 28 years. So this has shown how serious Fed is taking into consideration of combating the inflation. Now, just give a quick guideline. The inflation, the official inflation rate of US is about 8%, 8 point something, 8.1, 8.2. Then their Fed fund rate is currently between 1.75 to 2%. Okay, sorry, 5 to 1.75. So the question is, do we really need to hike the rate so high to 8% just to be on par with the inflation? Not necessary. Why? Because we have to know that increasing the interest rate has to the impact of it is not immediate to be seen. All right, they have to look at what the inflation rate, because the inflation rate is the past. They have to look at the impact of hiking the rate to see whether they will meet the equilibrium in the near future. So understand that the impact of inflation, the interest rate hike is not immediate. They need some time to digest, to monitor how it will compare to the inflation, to gauge the real interest rate, which is the interest rate minus the inflation rate. Okay. Now, if you put the things in the context in the graph, you will see, since the Lehman Brothers crisis, the subprime crisis, the US interest rate has remained slow at 0.25% for quite a number of years. So in other words, US is actually accustomed to a very low interest rate for a quite number of years, as you can see here. And then they slowly adjusted the rate until the COVID hit. All right. Now, once we enter the year of 2022, we see a 0.25, 0.5, and 0.75. This means in this year, the Fed has basically increased the interest rate to by 1.5% to the benchmark of 1.75. All right. So, of course, as I mentioned, the main reason for the rate hike is combating we actually want to fight inflation. If you look at Malaysia context, the same 50 ringgit that we are familiar with, in 1998, this is how much we can get. In 2005, this is how much we can get. In 2012, this is how much we can get. Basically, I think you cannot walk out from grocery store without spending 200, even to 250 ringgit for a week's of grocery, depending on your family size. There's no way you will work out, because if you're just going to buy a 5 kg of cooking oil, it will already cost you more than 50 ringgit. All right. Of course, at the end product of it, if you decide to go out and eat, just have a simple, the cheapest meal in Malaysian context, the roti canai or the roti kosong. Just an end product of oil and flour, it will cost us 2 ringgit and above already. So inflation is no longer on the statistic that we see on newspaper. Inflation is something that we see once we step out from a house. And in fact, we feel it even without us going out from the house. Okay? So the United States, with the US and Malaysia, is actually entering a high inflation among with other countries. Therefore, it left central bank no choice but to raise their interest rate. If you follow the news yesterday, none of us are surprised that Bank Negara actually raised the overnight policy rate, the OPR, by 25 basis points to 2.25. Oh, compared to US, that has raised 1.5%, which is a more aggressive move. In this year alone, Malaysia has raised only 0.5%. This is only 1/3 of what US has raised. So if I can give you a chart to give you a basic understanding, a clearer pictures of how US Fed fund rate has moved and how Malaysian OPR moved and how they actually move in tandem, I can give you this chart. Okay, so I can mention to you from the year of 2014, US interest rate was very low. From 2008 until 2016, 0.25%. And then subsequently, they raised their rate until 2.5 and dropped down because of the COVID. All right. This is Malaysian. Actually, in general, Malaysian OPR is always higher than Fed fund rate in any given point of time. The biggest spread between the OPR and Fed fund rate, if I'm using the OPR, the Fed fund rate, the biggest difference of it is actually about 3%, which is using the Malaysia OPR minus the Fed fund rate. Okay, but if we're talking about the lowest differences, which is I think is about now, is US Fed fund rate is about 1.75%, and whereby Malaysia, after yesterday, we have raised the OPR to 2.25%. So the gap between Malaysia interest rate and the US interest rate is the lowest of all time. Okay, I think the main reason the Bank Negara did not raise the interest rate so high, so fast, mainly is taking into consideration of the economic uh, as a general, but also we understand not just the household, not just the business, but also individual. There are a lot of them actually are having a loan. So if you increase the interest rates in an aggressive move, it will actually increase the bankruptcy rate, which is very bad for the banking sector, which is also very bad for the economy. I think that's why the central bank, as I mentioned, did not raise the rate as aggressively as US. And the other reason is because our official inflation rate is ranging between 2 to 3%, as compared to the US 8%. Okay. Now, if you are a home owner, or whether you're actually having a housing loan, or if you are having other sort of loan, okay, you may be wondering, okay, increasing rate will increase our installment amount by default. So is there any chance that no central bank will stop hiking the rate, maybe in a in a aggressive way? What are the, how should I say, is there any light at the end of the tunnel? Can they stop doing it? Because every time if you're a home buyer, you're having savings or your installment just like me, every time they say about increasing the rate, your heartbeat kind of pump a bit, right? So I think one of the things we have to understand, the main reason central bank increasing the interest rate is because of inflation. The inflation is a component of so many commodities and also food and among other things. So good news is, if you look at the closest one that actually has one of the biggest components that uh, in a weightage of inflation is the crude palm oil, the oil that we see. All right, the crude oil prices has dropped 11% to below USD per barrel. This is the news of yesterday because they are worrying about the economic recession by next year. So the demand for commodity has dropped down. So the good news, if you're looking from the ease of inflation point of view, this is a major news. Crude oil prices has dropped 11% to below $100 per barrels. Palm oil price has dropped 45% to year low, right? You know, Malaysia is actually one of the biggest palm oil exporter. Because of Indonesia no longer restrict its palm oil export, and our stock has been going up, and the price has been going down so much. All right, drastic drop in terms of palm oil. Good for general public, but it's very bad for the stakeholder. Okay, the wheat prices has dropped by 35% year to date, and also corn prices has slumped by 30%. Also, in this, what I'm telling you that they will actually put an ease on the inflation. Therefore, it may incentivize the central bank among the world to stop hiking the rate, at least to stop hiking the rate in an aggressive way. Okay. So this is general about from quantitative easing to quantitative tightening, and what we are looking at in terms of inflation as a whole, and what we are looking at as a comparison between Fed fund rate in US and Malaysia OPR uh, as a comparison, because we know that US is the big tiger there. Whatever they do, Malaysia have no choice but to follow. But the quantum of it, they will have to suit to how our Malaysia economic performance as a whole. Okay, so put the thing aside. So the other one is actually a case study of BR, base rate hike on loan repayment. This actually create a very big concern of the general public who are serving loan. Okay, so we just want to take a case study and actually want to see whether is a hike in BR with 0.25% really impact our loan repayments installments so much. Okay, so basically what it means that this guy is actually a civil servant, a government servant. he received a letter from the bank. Which bank we don't know, but because already like it, his monthly installment supposed to be 1450 a month, but following the adjustment, he has to pay 2072, increase of more than 600 ringgit. Okay, so the structure of his loan is that the principal amount he took for the loan is 100,000 4 years ago. So it means that 2 years left to settle. So I base the basic calculation. You take a loan of 100,000 personal loan, and for the tenure of 6 years. Okay, so if you do a quick simple calculation, if you take a loan of 100,000 for a tenure of 6 years, 6 times 12 is 72 72 months. With I work backward. I want to find out, if you have to pay 1,450 before, so your interest rate should be 1.44 only Okay, this is very reasonable. So with the adjustment of 0.25%, this one the new come out before yesterday rate hike. So we only do a 0.25% rate hike scenario. So previously he was paying 1,450 for the past 4 years. So if using the same calculation, all right, the months is 72 months still. If the increment of 0.25%, okay, you only increase his loan amount, so his installment amount by 11 ringgit. So what could be the reason that he has gone up by 600 ringgit? So I don't think it's because of 0.25% rate hike, and because the 0.25% by with everything remain the same, the differences is only 11 ringgit, not 600 plus ringgit. The only reason they can explain, okay, it's not as exhaustive, but one or two of the possible scenarios is a default payment. If there's a default payment that accumulates for the period of time, okay, the bank may ask for more installment, so that you can finish your loan on time. The second reason is that this guy probably have taken some moratorium during the period, when it was offered. And if the P still need to continue to complete the loan tenure as its original schedule, then he has no choice but to put in more, actually substantially more, in their monthly installment, because they already have 6 months, total 12 months already. Okay, so that could be the reason why. So the things I want to highlight to you is sometimes we see news like this, an increase in an increase in interest rate, they will definitely increase our monthly installment. If your loan is not a fixed rate, it's follow the daily BR rate or BLR or base rate, standard base rate, and BLR. But the impact of it would not be that much. Take an example. Okay, if you have 500,000 loan with remaining 25 years loan tenure, any increase of 0.25% will only increase your loan installment by about 71 ringgit. Okay, 71 ringgit for every 500,000, 25,000 or 25 years loan. But the advantage of it is that sometimes we have to look at things in bigger pictures. We have to know that because central bank will not raise their rate that fast, that much, if they are not seeing an economy back to the track. Okay, just a review. Actually, back to 2008 to 2013, Malaysia actually has experienced one of the greatest hike in Malaysia property prices, and this is in tandem with during that time, actually Malaysia already increased the interest rate on the increased interest rate trend. Okay, so the good thing is, as I mentioned, interest rate also indicate the economy is back on track. There's a demand from the corporate, there's a demand from the consumer, and there's a demand from the household to move the economy forwards. Okay, so without this, with this, I want to conclude my sharing for today, and the topic is about QT, and I hope everyone enjoy the session today. All right, thank you very much. Okay, I shall see you next time very soon. Bye bye.